Well, hello and a very warm welcome to this Scope Ratings webinar, ESG and Digital Transition as Measures of Long-Term Sustainability for Banks. My name is Keith Mullin. It's my pleasure to be hosting this session and delighted to be joined on today's webinar by Dirk Brandenburg and Nicola Aldi from Scope Banks Ratings team. Now, the team introduced the concept of sustainability modifiers into its bank rating methodology update at the beginning of this year. And on November the 8th, the team published an extensive research report that defined again the modifiers and included bank-by-bank updates on the modifiers assigned to 54 banks across Scope's rated universe. Now, that report will be available for download on this platform today. So in a moment, Dirk and Nicola will take you through a short presentation, and after that, we'll be delighted to take your questions. So please do type your question into the questions function on the screen as we go along. So without further ado, Nicola, Dirk, it's great to see you. Dirk, let's get started. The floor is yours.
Yeah, thank you, Keith. Welcome, everybody. So I will give you a short introduction of our relevant methodological approaches here to ESG. So you have to bear with me here. And then we will dive into the actual ESG focused research and the case studies that the team has provided for this note and also for this call. And Nicholas will talk you through that. So if we start with the methodology, I think the first points here to say is that it's an acknowledgement that ESG is going to become a more important issue both for investors and issuers alike. And so we started taking these factors into account via what we call an explicit long-term sustainability modifier that we added to our methodology at the end of January, actually, this year. So you can see this here on the bottom left-hand side of that slide. So key point is that modifier is linked to our assessment of the anchor rating, which is really saying we're looking at the business model, the operating environment, and then the long-term sustainability aspects, i.e. ESG, that come out of that analysis. And we're separating this out into this separate ESG-D factor. So we fully realize here that the ESG analysis of banks is still very much in its infancy as far as the credit risk aspects are concerned, because the risk factors here are actually difficult to measure, mainly because disclosure is by and large either not there, i.e. insufficient, or where it is available, it is often inconsistent between the different banks that provide that disclosure. It therefore means that for us, ESG risk is not yet at the phase where we can measure a quantifiable impact on banks' credit fundamentals, but we think we will eventually get there. And specifically here also, what we have done is we've carved out this digital factor out of the ESG, out of the social, which is usually around the social factor, because we see this as really the most pressing sustainability issue for a lot of banks' business models at this juncture. What I also want to highlight here is that we are fully aware, and we have commented in the past on also quantitative concepts that are out there, particularly, I think, the green asset ratio that was proposed in the EU most recently, and then also several planned sort of bottom-up stress testing exercises that are forthcoming by regulators. So we're not saying we're planning to ignore those, but we would expect to integrate that information as well into our analysis, as soon as it becomes available and is considered to be material. And that could then be both part of this ESG factor that we are introducing this year, but it can also feed directly into our analysis of profitability and earnings, and then most importantly also financial viability, especially if regulators were to add extra buffers here for ESG risks that then reduce the MDA buffers for banks. Moving on to the next slide. Our sustainability assessments are very clearly qualitative at that stage, and they're not based on any questionnaires we're sending around. There are no scorecards, and there are also no preset weights of any of those factors. Rather, we are looking at the most material ESG issues and form an opinion how proactively issuers are tackling them at this stage. So we expect that information to improve, mainly because investors are asking for more, and supervisors and also other stakeholders. And the real question here is that financial institutions that cannot meet those rising expectations over time, and they don't get ready for it now, they face potentially higher funding costs or regulatory consequences in the future. So in our assessments, we look at signs or 4 signs that management is anticipating these rising expectations and is taking steps to meet them in a timely manner. So this assessment is essentially looking at the preparedness of issuers to tackle ESG risk, and that's particularly again relevant for the digital transition risk, which we carved out of social risk because of the large amount of investment and the long lead times here for projects to provide value to issuers. Another important point here is that while our analysis clearly overlaps with some of the ESG impact scores that a lot of investors are using, our goal is different because, first of all, we're not trying to influence banks' behavior here. We're not taking any normative views about what banks should be doing. What we're focusing on is solely how ESG risk might impact the issuer's creditworthiness and ultimately its ability to repay debt. Moving on to the next slide, we are looking at the details here of our sustainability qualifiers. We summarize this assessment by essentially assigning this ESG-D rating qualifier, which can be either best in class, can be advanced, can be developing, or lagging. And that assessment can then result in a small uplift or lowering of our anchor rating. Usually it can go up half a notch or down half a notch. So the amplitude is quite limited at this stage, which basically reflects the sort of limited advances in this field so far and our ability to really differentiate credit on that basis. But clearly that could evolve over time. The other important point here is we assign those sustainability factors when banks are maybe best in class or advanced relative to their peers. So it's a relative assessment relative to peers with the respective region or a particular business segment a bank may be in. So it's not an absolute ranking or scoring that we are delivering here. And then we apply another important aspect, that there is a weak link approach, i.e. if there's a weakness, a significant weakness in one of these factors, it is not possible to compensate that with being particularly good at another aspect. And that's most visible, I think, around, again, either governance failures or just lack of digital investment and preparedness. So that cannot be compensated by then having particularly whatever environmental or social characteristics. And another aspect here is it's a dynamic framework. So it's about how an issuer is making progress. And that has to be either better or faster than the sector average. So to be advanced or best in class, it's usually the banks who have the most comprehensive management of all ESG factors, and that is measured relative to peers in that respective market. An important aspect here is to identify the materiality of those risks for banks' creditworthiness. And so we developed this analytical approach here. That is not part of our rating process and our methodology at this stage, but it is an analytical tool that our analysts use to essentially organize their thoughts and also stimulate discussion about the names. If you apply this matrix to banks, then you quickly arrive at a pretty clear pecking order here in terms of materiality. with governance and digital most likely to drive the credit risk differentiation for banks. Has to be said that for large institutions, and that's the majority of our sample at this stage, that governance concerns are the exception rather than the rule, because those banks tend to be very well regulated. There's a lot of oversight and also very high investor expectations to deliver. And that is reflected in their ESG profiles or in their governance profiles here. But it's quite clear that governance failure could drive a lot of credit differentiation as you move into smaller banks. And that's not 100% reflected in the sample we're presenting here, but it's something to be aware of. In terms of governance, typical differentiation here on the negative side arises, banks that being investigated or are frequently into news, particularly around AML, corruption, sanctions, and other misconduct issues, and then also litigation and regulatory investigations that run on the back of this. So that tends to be quite a differentiating factor. And another issue here is also if that then results in frequent management changes and changes in strategy, again, that could be quite a negative differentiator in this area. And then switching over to the other big driver in terms of materiality, the digital risk, that is really very much based on assessment relative to the business model. So the question is, is it business model that is less likely to suffer from competitive disruption? So, particularly the area of sort of corporate investment banking on one side versus retail banking, which is very vulnerable at this stage. Or also then the question, is the bank, or how well is that bank equipped to deal with that disruption if it then arrives? And that can then either convert into an opportunity or competitive advantage or not. So banks who do well on that scale, they could receive an uplift here on the digital assessment, and same way on the negative side, if it's banks basically where the investment is not keeping up with competitors, and it results in poorer digital offices or very poor back-end processes, and an anticipation that there's very high investment need ahead here, which will depress profitability. So the one point to make here now is that once we've gone through the digital and the environmental, the governance aspect, it appears that at this stage, the environmental and social risk have not emerged as drivers of our long-term sustainability assessment. That doesn't mean it couldn't change, and it could actually change soon, because clearly it is expected of banks to provide strong management of climate risks and also tap sustainable financing sources. But the standards for this, and also I think the timeframes over which this has to be addressed in the sector, they are still emerging, and they're not really proving that material at this stage. So I think that's quite different from, let's say, a scoring approach, which will probably put a much bigger emphasis on environmental, and in particular climate change at this stage. But we believe that within the rating horizon and within the already very high quality credit quality of banks, that these risks at this point are less of a driver of our analysis. So if we then switch over to the main findings, so since we put that methodology through, and that was at the end of January this year, and then until the end of October, which is what this data set covers, we put good 50 banks through the standard committee process where those sustainability qualifiers are signed. And you can see the result here, both in terms of the distribution of the qualifiers, and then also in terms of their impact on the actual rating. So not surprisingly, most banks are in the developing category at the moment. So that is to be expected, because it's an analysis relative to peers. So there will always be a big sort of normal distribution around this, or some form of distribution. But it also shows that it is actually quite hard to differentiate banks on their ESG credentials at this stage. So all in, we only found that about a quarter of the sample sort of deserves some positive impact assessment here. And it really leaves us with a very large of banks where it's either very average or indeed not very well understood, nor measured or managed by those banks. So this leads you to the overall assessment that banks are gradually embracing changes in this area, but it's a slow and very limited impact actually in terms of materiality for our credit ratings. Another interesting observation from this sample is, it's not a surprising one, but it's still worth highlighting, is that there is a bias here in terms of the advanced or best-in-class operators, that these tends to be the larger banks, or the banks which you also consider to have stronger business models to start with, which is essentially attributed to this better governance, greater stakeholder sophistication at larger banks, and also simply the resources that these companies have to allocate both to ESG risk management but also to their digital transition. But one point here to make is that this is, there's sample bias in here. So we so far have analyzed mainly the large banks, and also there's the most information available. And as we add more, or the remaining part of our bank universe, that analysis could still shift, and it's by no means excluded that we also find positive signs in smaller banks that we have yet to analyze. To give you an overview here of the actual universe, you see that on the next page. So these are the qualifiers of 54 banks that we had put through this analysis by the end of October. That is a good 2/3 of our coverage. So there remains some more to come, but I think it is clear that just with the normal review cycles of rating agencies, that rollout will complete by January. So we can then provide you with a sort of full rundown of the universe. The other point here, before people sort of focus too much here about the rankings, let me remind you it's a relative approach. So it's the sophistication of an issuer relative to peers in their respective region or business segment. So that's why you may miss some of the sort of more familiar names at the top of the ranking, but that may simply be because they are already in a very advanced, particularly in digital, in a very advanced market environment where it's much harder to achieve differentiation in this field. Another point to make here is that these are just one qualifier out of a much wider rating methodology we apply. So I just want to make sure that people do not draw direct links here between this ranking and the actual rating we assign to these banks. These are available, but they are available to our subscribing investors. So we can't share them in this public call here, but anybody who has access to our website will find the actual underlying issue ratings and all other analytical information on there. So with that, I suggest we drill in on some of the names we have in this analysis, and I hand this over to Nicholas at this stage. In the note that we published, and that's available also, I think, for download on this website, we have about 15 case studies, and Nicholas will talk you through some of the highlights out of these.
Thank you, Keith. Good afternoon, everyone. So as Dirk mentioned, the goal of this assessment is really to refine our views on business models. So here we are looking at evidence that banks are transitioning to remain relevant. So we are looking for evidence that they are navigating the transition and taking ESG seriously. Basically, that's the main goal there. So what matters really here first for us is first the quality and the scope of disclosures. We also view to what extent banks are engaging in industry initiatives, active participants in industry initiative. And this is also often for them a place where they will have to comply and align with targets and metrics. And we take this as an indicator of awareness and preparedness. So that's the first set of information we look at. The second is when we look at business model, we review to what extent banks are mobilizing their internal resources and business mix to adapt. And this is what we would like to illustrate with this sample of 4 banks. So many of the large leading European banks have supportive features in common when it comes to sustainability initiatives. We have examples with Santander, material ambition there to shift the loan book and have a significant exposure to green finance by 2025 above 100 billion. And we like the materiality here, the willingness to make a change. In terms of disclosure, we have, for instance, BNP Paribas TCFD report. We like how the strategy there is articulated, the refinement of the metrics proposed. So those are 2 examples of issues we look at to qualify our assessment. What makes a difference then for those 4 names? As Dirk mentioned, digital often makes a difference on the way up, and governance make a difference on the way down. And this is what we have here on the screen. So I'll start with BNP Paribas. So best in class for us in this benchmarking exercise. What we value with BNP Paribas, apart from the quality of disclosure in those specific areas, for instance, sustainability, what we really value is the variety of the businesses that are transitioning to make a difference. So it's really more on the competitive side of the issue that we give an uplift to the rating for BNP Paribas. And we have what we like is this variety of business mix, also geographically. So BNP Paribas is active in asset management. It's active on insurance activities, 2 areas that are probably more advanced than the banking industry. So for players that have large operation in those 2 segments, it makes a difference because this is pushing for the rest of the business to follow also in terms of awareness at senior management level. So we like this. We like also presence in either other more specific areas like car financing, for instance, with Arval. So here you have the ability, like for others, like Societe Generale with ALD, you have the possibility to really grasp opportunities on the ground with the change in terms of mobility. So this is what's also very interesting for us when we look at BNP Paribas in terms of digital transition is also how they are developing various solutions to cater for the needs of retail clients and how they expand their geographical reach using digital tools. So we like the omni-channel approach, which is relatively traditional. We also like development of the digital bank, Hello Bank, for instance, and we like also the introduction of innovative solutions like Nickel, for instance. So we like the full suite of products, and that's really strengthen and supports the best-in-class assessment. If I turn to Santander, again, I think it's really the digital transition that is making a difference also for Santander. We like really the payment solution business, how it contributes to the overall relevance of the business profile. Also initiatives in terms of digital consumer bank. So a global approach and efforts to develop locally digital solution. And it's really a strength for this banking group. When we look at ING, we can see that ING is very active in sustainability initiative. This is also true for other Dutch banks. There is a high standard in the country. What makes a difference again for ING? It's digital footprint. It's really a front runner. It has been the case for years. It's really a pioneer in this field across Europe. So the challenge probably for ING is to remain a front runner. And what differentiates for us ING versus, for instance, BNP Paribas and Santander, why ING is not best in class? It's really because we also factor the governance issues that the group has been facing in recent years. And they are still applying remediation action on that front. That was also the case for BNP Paribas, but they have made better progress, I would say. They are more advanced. It's more now of a legacy issue for BNP Paribas. So we don't penalize the assessment for that. Now, when we turn to HSBC, it's another interesting case in terms of governance, and that's the main reason why we have a developing assessment for HSBC. Of course, it's a very active bank in terms of sustainability initiative, quality of reporting, and digital solutions. But here, given the fact that in the overall rating construction, we already factor the strengths of the business model. It's one of our highest assessment. With this ESG-D assessment, we have the opportunity to flag for investors the issue they face in terms of governance, the interplay between governance and geopolitics, between being in the UK and in Hong Kong. So we use this assessment to really highlight this issue for HSBC, how it is going to navigate this over time. So Dirk, back to you.
So thanks. Oh yeah, I was on mute there for a second. So thanks for those comments, Nicolas and Dirk. We've got a bunch of questions that have come in. So I suggest, if you're okay, we'll go straight to questions. I think that, well, I guess there's one which is hopefully pretty straightforward that I can put to you, which is, are the assessments of banks with respect to the ESG solicited or unsolicited? Can you hear me okay?
Yeah, sorry. I didn't hear didn't hear the question actually. Can you repeat it? I'm not sure the audience heard it either.
All right. So, are these assessments of banks with respect to ESG solicited or unsolicited?
Okay, thank you. Yes. So main point here is, I mean, scope ratings as such, we have mainly subscription ratings. So those ratings, they are technically unsolicited, although we often cooperate with the issuers in question. And then there are a few solicited mandates as well included in this analysis. So it is a mix.
Okay, very good. Thanks. And I think Nicolas, perhaps there's one for you. Which I think is a key question, which is this: why is digital assessment so important in your approach, unlike with your peers?
So if by peers you mean other rating agency, I think I don't have an answer here. What we believe is that digital transition is really a sector-specific issue for banks, and it's critical for them to be on top of issues regarding digital transition. So it's usually, as Dirk mentioned, digital is part of the social assessment in general. This is where you would see information on digital transition. Social is about relationship with stakeholders, with your customer, with your clients, with other stakeholders like regulators, local communities. We really believe it makes a difference for banks specifically to be up to speed in terms of digital transition. And this is why we have a separate line out of the S to cover this issue.
Yeah, maybe we can add one point here. So if you think about traditional ESG analysis, that quite rightly focuses on sort of the long-term aspects in the business model. And so if you sign credit ratings, there's obviously a shorter rating, sort of default rating horizon that you apply, which is well below the sort of 2050 analysis that is used in climate risk. But at the same time, as we push out this horizon, and that's why we're doing it on the business model, which is sort of the slow moving but long-term aspect of the credit analysis. We have to really treat all the long-term risks on an even keel. So we could also put a lot more emphasis on environmental risk, particularly on climate risk. And I know there's a lot of interest and pressure on this. But then we also have to say, well, what's the materiality of climate risk over that 3 to 4 year rating horizon we have? And we'll probably conclude, well, it's clearly rising, but it's not sort of overarching. It's not driving everything here in our analysis. While on the contrary, if I look at the sustainability of a bank's business model, then I will probably quickly conclude is that a bank that hasn't started investing in its digital transition and who can't keep on investing in it, within a 3 to 4 year horizon, will have a real problem in terms of its competitive position. And that's ultimately what's then driving our issuer risk assessment. And that's why this has at this stage a bigger importance. That doesn't mean it can't change again if we roll the analysis forward by another 2 years or so, and also if more data becomes available that allows us to differentiate banks on, for example, their environmental characteristics.
Yeah, it makes sense. Nicola, when we talk about digital transition risk, it's one of those phrases that I guess could mean lots of different things to different people. Are we talking about what I call, front-end digital transition on the product side and on the availability of tools to clients, or are we talking as much about the, automation of processing at the back end using algorithms and all sorts of automation tools? How do you define it specifically?
Yes, you're right. There is a variety of topics behind digital transition. So the way we structure our assessment, we look at basically at 3 dimensions. So the first one is about what we call the front-end solutions. So typically the interaction with clients. What are the solutions provided there? The second aspect is about back-end solutions. So how banks are transitioning from legacy IT infrastructure to more agile infrastructure, moving to open banking, for instance. So this is the second aspect. And the third aspect important for us in terms of digital transition is how banks are managing data. So data protection, data management, and also cyber security. You can see that from front end to back end to cyber security, there is also this issue to get knowledge of what the banks are doing. So cybersecurity, for instance, is ranking high in terms of risk for the industry. At the same time, it's also a risk for banks to disclose too much on that issue in the public domain. So we rely also on initiative at industry level, at national level, also industry initiatives to protect the bank industry.
Indeed, thanks. And moving perhaps to a different topic, Dirk, you talked in your comments about materiality, and there's a question here about what do you mean by sector materiality? Can you just kind of go into that a little bit more?
Let me just go back to the slide here. We're talking about the materiality assessment. So this is sort of generic formula here. So what do we mean by materiality? Well, it is really about what is the impact on credit risk, i.e. ability to repay debt. So that's different from ESG scoring, because ESG scoring, everything is material. Right? You look at environmental, you look at social, governance risk, and then the scorer or also the investor who relies on those scores, he will put a lot of emphasis on all 3 of them. while we always have to ask ourselves the question within the rating horizon and within the business model and the type of bank we're looking at, which risk is actually material, could be material to the future ability to repay debt. And that's why we then have to be, I wouldn't say ruthless, but we have to be pretty clear around what's the link between any of these ESG and D factors and future debt paying ability. So that's the difference between, say, doing ESG analysis and then the point of integrating the outcome of that analysis into the actual credit rating.
Okay, thanks. And Nicola, there's a question that's come in which is pretty topical and pretty on point. And I'll just read it out for you. I think you've already seen it in the system here. But it says, how do you reconcile assessment of the banks who have borrowers advancing E, like producers of photovoltaic, but at the same time having issues with S or G, i.e. using political prisoners or children to produce solars or photovoltaic cells? It's one of those kind of, how do you sort of, I guess, weight and differentiate between the sort of positive and perhaps less positive factors in the way that you weight the modifier?
Yeah. Yes, interesting question. There are probably two dimensions here. The first one is how do we factor the weak link approach at the bank level? So how rapidly the bank is coping with stakeholder demand in terms of environmental initiatives and facing potentially some governance issues. So that's one thing. And we focus on this one. The second one is to really understand, I think we are not yet there, to what extent through lending activities, banks are exposed to sector that would probably create some issues in terms of ESG assessment. And banks are working hard on that. They are helping their client to transition. And they are also becoming to be more selective. So we have the risk also of stranded assets. We have banks that are taking position in terms of exclusion. They no longer want to do business with some sectors. So that's a way to address the issue we see there. And other banks are also very clearly stating that they are financing the economy at large. And they will, we will see their portfolio transitioning while they accompany really their clients making the same transition. So to make it short, we do not penalize banks because they have such a variety of exposure, and we don't think we have this level of transparency available for the moment, but we are getting there. And Dirk mentioned the green asset ratio initiative. This is probably going to be a game changer for the European industry very soon.
Absolutely.
Yeah.
Dirk, there's a question I've got here about the key drivers of the modifier between the different components of ESG and D, and you kind of touched on this a little bit. Can you just perhaps reiterate what the key drivers of the modifier are? And I guess a follow-on would be, would you expect the drivers to change over time, given either bank level changes or regulatory iterations?
Yeah, so the key drivers of the modifiers is essentially, first of all, tied to the horizon we're looking at. So we're looking at a typical 3 to 4 year rating horizon. So that excludes essentially a lot of the climate risk aspects at this stage, simply because over the next 3 to 4 years, particularly the physical climate risk, I know it could get really bad after that. So I'm not trying to belittle this in any way, shape or form, but at this stage, these factors are less important, but clearly they could become a lot more important, certainly if we believe the sort of views here are also coming out of the regulatory community. And then there is obviously transition risk, so that could eventually translate earlier, simply because there are policies that get implemented, like carbon taxation and what have you, that would actually could accelerate that assessment. So then obviously we would have to review that and incorporate this earlier than expected. So that's a possibility here. But that's essentially where we are on the environmental factor. On the social factor, what's important here, I think that is probably a factor that's actually quite important as a kind of slow burn issue, simply because banks fundamentally are built on their reputation, i.e. the willingness of people to give them their money and interact with them. So I think if you look back, the social factor would probably have been really important after 2008. When we didn't have that framework explicitly in place. It is probably slightly less important at the moment, simply because banks have made a lot of progress on this front, and sort of have been able, particularly also due to COVID, been able to sort of redeem themselves a bit and improve their reputation, i.e. on the sort of part of the solution rather than part of the problem. So I think that factor may not be important at the moment, but certainly would have been important in the past and could reemerge at any point in time, particularly if there are sort of issues we've seen on money laundering issues and litigation and so forth. And then, you're really down to governance and digital as being the sort of main factors at this stage. And as I said, the governance probably not that relevant for the very large banks, simply because it is generally quite good, and they're also all listed, and there's all kinds of people scrutinizing them all the time. But clearly an issue for smaller banks. And that's a limiting factor on all the other analysis. So you cannot compensate a weakness in governance with any other aspects of this framework. And then as particularly with this sample we're discussing here today, and I think it came out really nicely in Nicola's presentation as well, that it's just a lot at the moment is focused on digital, which in theory you could run as a standalone rating factor, but in the wider ESG world, it just happens to be part of that social factor, and that's why we explicitly also split it out, so that we can differentiate it's better. But that is within the current rating horizon, relative to the business models, i.e. the very large business models we're dealing with here in this sample, that it happens to be the key factor.
Yeah, thanks for that. Nicola, there's a question here really about the fact that in the report, actually, and it relates to the report. The report notes that the information that's available is self-declaratory, is unaudited, and it's selective. Now, you did mention that it's not 100% qualitative, the factors that you look at when looking at these modifiers. There's some quantitative aspects as well. But can you just briefly talk about the challenges, the lack of a global data standard around any of these factors? Really, what challenges it bring into when you're trying to come up with some kind of framework here?
Yes, so I think it's fair to recognize that the regulatory framework, the regulatory demand on banks in terms of reporting needs improvement. So we cannot just blame banks for the lack of quality reporting. I think it's really a work in progress. This is changing rapidly, of course, and that was, I think, a way to onboard an increasing number of stakeholders. So we know that the European regulation on ESG related disclosure for the moment is really open-ended. We are still at a stage where standards are just emerging. So that's an issue we all face, but that's also an opportunity for banks also to have a higher quality disclosure. And for instance, we really like the TCFD framework, so the Task Force on Climate Related Disclosure. This is really well organized. We have 4 pillars there. We have governance, strategy, risk management, target, and metrics. It's on climate risk, but you could also use the same framework for digital transition. It's extremely relevant also for digital transition, strategy, governance, risk management, targets, and metrics. So again, it's an opportunity for banks to do better than others and differentiate themselves. And banks are already publishing their second, third TCFD report with every year a higher level of sophistication, more refined strategies, and this is what we value for banks in general.
Yes, indeed. Thanks. Gentlemen, we've got no more questions. Actually, there's one more question I wanted to ask to take us out. But so if you have any more questions, those of you still watching, then please do type them in the next minute. Otherwise, we're going to be closing very shortly. But just to take us out on the session here, can you just summarize key takeaways from the ESG-D analysis that you and the team have conducted on a sector-wide basis? You kind of mentioned it here. I mean, this positive negative, it's pretty heavily weighted towards the negative. Are banks making real progress, or are they moving more slowly than you might have expected?
Yeah, so I mean, there's I would say that's not specifically to banks, but I mean generally there is always a discrepancy between sort of the public face, the marketing aspect of franchises, and then the actual delivery. So that is not specific to banks, but it would appear there is that disconnect at this stage, which means there are a lot of ambitions, and I'm sure some of them will also materialize, but. Question is, okay, some people may have just simply started too late on this, others just may not have the budgets for it, and so overall there is an element of disappointment here, I would say, relative to sort of the outside face of this question. I mean, that's also been, I think, acknowledged by some recent ECB study who sort of said, I think, similar things, particularly on climate risk. So that's just what we're living in. Is this better or worse than in other industries? That's, I guess, an open question here. The banks we're looking at are very large. They have very, very large balance sheets, so they're not easy to turn around if the operating environment changes. And so we're with this sort of slow-moving tanker problem as well. But then one other point here to see is that this is a relative analysis. So you will never have all the banks best in class, because ultimately what we're looking at is, what improves the competitive position, i.e. the sort of debt service, the cash flow generating ability of a company relative to all the other companies that are out there. So we would always expect to have a kind of distribution around this with, some positive outliers, some negative, and then a lot of people just in the middle who are just the relative benchmark here. So from that angle, I'm not so surprised at the result, but I think, if the overall takeaway is that a lot more needs to be done in this area, and also a lot more information needs to be made available. And I think that was a good question there initially, kind of, what do you do about banks who have this exposure and that exposure? Well, that's a very good question, but the question is, do we know all these exposures, and then how do they get reported? So I think that field had also to improve, and that's why it is by and large at this stage work in progress, I would say.
Yeah, absolutely. Actually, while you were talking, Dirk, we got two questions came in just under the wire. So as someone's taken trouble to type them in, it'd be rude not to have a go at answering them. So Nicola, let me put the first one to you, which again it's very topical. It says, most likely we will have not just one but a few taxonomies, with the EU being the most radical. How do you see the probability that radical climate agenda might impact banks?
Yes, very interesting question. So the regulators are behind, also are pushing for that. It's not in Europe, it's not only the EU Commission, but you can see really a convergence among EU authorities to help banks and the economy at large to transition. So in terms of financial stability, I think that's also on the shoulder of the regulators. You cannot just expect radical change in a short period of time, the risk of stranded assets, the risk of rising asset quality. I think we need to transition in an orderly manner, maybe accelerate, of course, and I think this is what the regulators and the EU authorities are doing. But radical climate agenda, maybe, yes, impact investors are pushing on banks to be more active. There is stakeholder demand rising year after year. I think it's obvious, it's changing year on year. But that needs to be aligned with the speed at which the economy is changing. Again, we have seen banks being used as utilities during the pandemic. They can be used again as utilities to help the economy to transition. I don't think personally they can go faster.
Yeah, absolutely. And Dirk, it's a question here about what informs your analytical approach, which is to what extent do banks' own climate stress tests and scenarios inform your ESG assessments and credit ratings? Do you agree with the scenarios used by banks, i.e. that of the European Energy Agency or other?
Yes, I think the point here is that the fact that banks are doing this climate stress tests and that they're putting essentially strategies in place also to, I guess, deal with the results of these stress tests for themselves, that is a positive, and that is part of this whole approach where we say it's ultimately at this stage about management awareness and trying to get ahead of the curve here. So I think we do take that into account, and that is a potential positive, which then competes with all the other factors here. As regards to the usability of these stress tests, I think the problem we're having is the comparability, and that makes it hard for us to basically brush all the banks over one of these criteria, and that's really where these regulatory stress tests, and I did mention them on the initial slide, come in, where we're basically saying, yeah, someone ultimately will come up with these climate stress tests. They will feed into capitalization and liquidity, and it's at that point where it matters to us. So it is really up to especially in our case, European regulators. So that's the ECB, Bank of England, and the like, to put those frameworks in, and then also explain how they assess the capital position of banks on the back of it. And that would have a pretty direct impact actually on our assessment and of financial viability. So hopefully at that stage, the management teams have already factored into the business model. I mean, that's what we're capturing at the moment, the proactive stance here. But ultimately, we're still lacking that type of, first of all, disclosure that comes with that, and then also the how it's been actually applied to the banks.
Yes, indeed. Thank you for that. We kind of out of time. There are a couple of questions which are slightly off our topic today, but if we haven't answered your question, then we will actually circle back to you on a one-on-one basis. So I think the questions perhaps need a bit more thought, which are not really relevant to today's subject. So Dirk and Nicolas, I think let's close the session today. Thanks so much for your comments and for answering those questions. Thank you to you for tuning and watching. I hope you enjoyed that and found that useful. Please download the report, which is on the download button on your screen, which is the report that Dirk and Nicolas mentioned, which has explains the modifiers and also goes through quite a few bank by bank assessments. And so this subject is clearly not going away anytime soon. It's a critical key subject, not just for banks, but for all sectors. So we will be back for more as and when appropriate with more on ESG and digital. And so feel free to reach out to us if you have any thoughts, any questions, observations, anything more you'd like us to address in this webinar format. The webinar format is intended to really act as an outgrowth of the research format, and as a way of actually just creating that better engagement with market participants. So that's it. Thank you so much for your time. Be safe out there, and we will see you next time. And goodbye for now.
Thank you. Goodbye.